All right, let's hop on in. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and a member of FINRA. All of my trades are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. There is the position disclosure there. I started to build back in and nibble on a couple of things. Some shops, some Microsoft, some Meta, some pins. Which pin's getting bit up here a little bit after hours on the Elliott management seat, so I'll take it. Quick overview of the market. Another bearish day. SPY's down 1.4%, Q's down 2%, IWM down 8.5% as we had a second downtrend day in a row today. Quick view on the technicals. Obviously, we trended pretty much down all day. Kind of got this little bit of a lower high as we came into 330, and then, you know, like I said, sometimes, definitely not always, and I see it more of as a phenomenon on bullish days than on bearish days. But we kind of had it 2 days in a row. Yesterday was maybe more stabilization than a pop. Today was a little bit of a pop in the close. You have these very small time frame trend algorithms that when you're on a clear downtrend that's riding a moving average, they're just short-term robots trading the market that are shorting, but don't want to keep the overnight exposure, so liquidate the position in the close. So sometimes last 30 minutes of the day, sometimes even last hour of the day, you get a little bit of a move in the other direction just on these big kind of trend days. Again, I see it more on the upside than on the downside. It's not necessarily something that I would want to count on as a short-term trade, but it is something, some stabilization or a bounce that you kind of see very regularly there. Interesting close in the market. Yesterday they closed me pretty much right at the key $400 level, and today they pretty much closed me right at the key $393.50 level for the SPYs. I was saying $400 below that is where you kind of lose the trend's momentum, but the trend itself is still intact. Below $393.50 is where you actually lose the trend. So we traded below $393.50 today, but we managed to just barely by 33 cents close above it. That's after a couple days in a row here of really heavy selling. So technically, we are still in higher highs and higher lows because we did not close below that low, but things are certainly not looking good, and we'll look at the Qs and the IWM to see if we get any confirmation there. But things are certainly not looking good. The small time frame, if it's not already with a broken trend, it's very near to it, and that would bring us from small time frame technically bullish, where you want to be having that consistent cautious optimism kind of concept that we have spoken about, erring to the side of longs, to neutral. And the question really has been, this big time frame downtrend, the small time frame uptrend, which is going to win? And like I've said almost every day, the bigger time frame is usually what wins. And when you've got a 200-day, getting above or below a moving average is usually never as important as the slope of that moving average. Slope of that moving average on the 200-day is still down, so that means on a big picture, your bounces will still tend to fail. Eventually, someday, somehow, somewhere, that will change, I promise. But that could be very far in the future, or it could be closer to the present. And there's no real way to be able to predict that unless one of you guys has a magic crystal ball and you can look into it and you can tell me about it. Do we have confirmation from the Qs and the IWM? We do not yet on the Qs on a full break. I think that would come, again, below the Powell day low. So basically 280 in the Qs is the key spot. Low the day-to-day in the Qs is 280 quarter, and we managed to close a little bit above that. I'm trying to find my closing print on here. We closed at like 281.70. So SPYs barely intact. Qs slightly intact. IWM broken. IWM here really lost its level, lost its Powell day low. It even lost its lows from the CPI day. So IWM here is broken and is going into neutral territory. So at the end of the day, we're certainly not looking good, but we still have slightly mixed signals. SPYs being barely intact, Qs being intact by just a little bit more, but certainly not looking good, and the IWM being broken. So we'll see what happens. Tomorrow is day 3. Usually it's pretty tricky to see 3 days of massive downside continuation like that, but we have seen it several other days within the confines of this bear market. All right, so now that we've kind of gone over the technicals, I just want to re-highlight a piece of information. Dang it. I was going to copy and paste it into the VTF. It was from this morning from Pat, and I lost it when I was starting the meeting, so now I'm going to scroll. I'm going to scroll all the way up here in the VTF to about 8 a.m., because I really want to refine this note from Bank of America, because it kind of triggered a thought process in my head this morning that I chose to ignore, and I probably should not have. Sorry, as I scroll back up, the VTF takes a very long time to load, so I'm only up to 10 a.m. here. But I want to re-highlight this part of the information that Pat was providing, because I think it is important. Here it is from 8:05 a.m. I'll copy and paste it into the VTF. Copy, paste. Boom. A lot of information there. So this is Bank of America kind of giving, I guess, a guide to 2023. And I'm not going to read all of this. It's pretty long. You should read it on your own if you did not read it already. But I'll kind of give you the highlights here. The highlights are basically, and this is coming from Subramanian. I think she's pretty good. Basically, the highlight here is that they're expecting this dip to. We've kind of seen this already, right? This isn't like brand new, I don't think. We're expecting this dip to basically 3,000 in the first half of the year, and then they're basically expecting the second half of the year to be a rally, and the market to kind of work its way all the way back to, I think, more or less kind of where we're trading now, the SPY 4,000 area. And basically it kind of gets into the reasons why we'll be weak in the first half of the year: recession risks, earning cuts, quantitative tightening, high inflation, and then that stuff will begin to pivot into the second half of the year, and that kind of creates a little bit of a market rally. And there was an interesting spot in here also on a survey that they did, and I'm not a huge fan of surveys. I don't remember who it was, but somebody's got a great quote, which is, "Don't tell me what you think, show me your portfolio." And I really like that quote. So I really take surveys with a massive grain of salt here. But our client survey from whatever, only 15% of respondents were positive on equities next year, but 60% expected a sell-off in the first half of the year, followed by a second half rally. And then it kind of gets into a little bit on what you can focus on, and it seems like they're recommending being involved in high-quality stocks, energy, financials, dividend stocks. We expect dividends to represent a much bigger chunk of total returns, and it specifically says that they expect that small and mid caps are going to be able to benefit over large caps, and it kind of warns here to be away from some of the mega caps. So that's kind of the gist of it. And again, I wanted to bring that up here in the meeting as we're looking at the market, because I was reading that this morning, and we've seen a bunch of other similar stuff here. We've even seen the JP Morgan guy, whose name is escaping me again off the top of my head, like a Polish type name, like suddenly become a little bit bearish recently. Yet out of nowhere, in the corner of my eye, I'm seeing on the TV that Gunlock is bullish. Klonovich, yep, thanks. So I'm just looking at that though, and I'm looking at this market this morning that has been in this small time frame uptrend, and I'm just like, well, if this is what everybody thinks, right? If only 15% of respondents are bullish next year, 60% think that we're getting a big sell-off in the first half, well, then how the hell are we even holding up at SPY 4,000? The market's a forward-looking mechanism. So yeah, there are some things here that we as a team have pointed to that has enabled us to kind of capture this big rally. But as we come into this spot that's more technically difficult, and if everybody and their mother thinks that this market is really going to work its way down to maybe S&P 3000, well, why are people not getting ahead of that already into this point. So, my thought process is always listen to the technicals. Yeah, and certainly could be a self-fulfilling prophecy. My thought process is to try to always listen to the technicals because, again, I'm quoting a survey here, but the technicals actually really tell you the information from the market. And the thing about the technicals is we've had this small to intermediate time frame uptrend. We've gone over this 1,000 times within the confines of this big time frame downtrend, and that can certainly lead to bigger failure. It just almost feels like to me, if we're going to this S&P 3000, that we should be even lower. Now, with all that said, as I'm like this morning, well, whatever on this analyst, whatever she's saying, because the market's been trading really well, everything that she said today was like, that she said in this was like actually playing out today. And I've mentioned this in the past also, and I was talking about it a little bit today, and I feel like we're really starting to see it now. I was saying about a month ago or a month and a half ago that I don't think that the correlation between treasuries and the S&P is going to continue to hold up. And this is something that people have asked me about a bunch of times this year, especially newer traders who haven't seen a lot of different market environments where, everything's kind of been selling hand in hand. And again, if you look at the statistics, obviously 2022 is not closed yet, but this is going to go down as one of the worst years in history for like a 60-40 portfolio. If you're long bonds and you're long equities, I mean, just been a complete terrible year. But for probably more times in my career than not, even though I do think that the relationship between the equity market and treasuries is kind of constantly evolving based on the narrative, for probably more times in my career than not, there's actually been more of an inverse relationship with bonds than with equities, where bonds are viewed as this like safety play, where when people are really fearful, they sell their higher risk assets, they sell equities, or if they are still involved in equities, they're rotating to utilities and consumer staples, and they're buying things like treasuries or maybe even gold. I've seen a lot of historical analysis that shows that treasuries have actually fared much better in weaker equity markets than gold does. And this year has been interesting because it's just been sell, right? And the argument this year's narrative has been selling in the simple part of the narrative has been selling in treasuries means higher interest rates. Higher interest rates reduce equity multiples. They're particularly bad for long duration equities, i.e. growth stocks. And that's entirely what we've seen. We've seen the treasuries get hit, and we've seen the equity market get hit. And I've been saying here into the end of the year, because I've also been talking about how I'm expecting a narrative shift that begins to move from inflation and interest rates and the Fed to the economy. And coupled with that, I'm expecting to see a change in the relationship between treasuries and equities. And we're actually seeing that now. Like at first, this rally in treasuries was also a rally in the equity market, right? Interest rates are coming down. You have a little bit of that easing impulse that's helped this latest bear market rally kind of get some teeth, but not in the same way recently. And really these 3 days here, like the last day of November, first 2 days of December, scare me a little bit because this rate of ascent with what the market's kind of been doing on those days, it's really beginning to look to me more like a fear trade for the first time. For the rest of this year, it's just been kind of sell everything. And now it seems to me like people are coming into treasuries and taking advantage of the higher interest rates that are there, but they're doing it as a fear trade as they're actually trying to get out of the equity market a little bit more. And I just think that Bank of America note, and again, I don't do what she does. I don't make these glorious calls on, if someone wants to ask me on January 1st where I think the market is going to close on, on December 30th, whatever, 2023, I'll kind of just laugh at you and give you a sarcastic response. I don't play that game. I leave that for CNBC people who are just trying to draw eyeballs on them and not really provide information. So I got no idea if we're going to go to 3,000 or not. I would never make that prediction. I kind of take it one day at a time. But I just would say here that on the smaller kind of time frame more recently, it really does seem like we're starting to see that change in the narrative in the price action. And the way that we're seeing it is through this fear trade. It's through TLT getting bought up. It's through look at XLU today. The market got smoked. XLU's up 0.5%. Super strong rally into the close. DUK just really really impressive how they kind of bought that up. So it seems to me like we're starting to see a little bit more of that fear trade that's actually coming in. Treasuries are getting bid up, and that means that interest rates are pulling back down a little bit, but you're not seeing what we've seen in the past with that market moving higher. And the dollar here, even though it gained a little bit of strength over the course of the last couple of days, is still below that key 28.50 that we broke down from, let alone the first breakdown that we had of 29.50. But this isn't reacting to me in the same way for the equity market as it was either. So I don't know. It's just the one thing that I really kind of want to note to you guys, that I'm seeing that change coming in and this narrative begin to change as these technicals are beginning to deteriorate. And if Bank of America is going to be correct, I don't see why they would wait for the first half of the year. If everybody thinks that we're heading to S&P 3000, well, who the hell is still buying the market at S&P 4000? It just doesn't really make just doesn't make a whole ton of sense. So we'll continue to see what happens into the end of the year. I guess the real big Max Payne FU trade, which I also don't want to call for because there's no technical basis in calling for it, would actually be the market to shake out these short-term longs and then reverse back up, break this high, and break this downtrend. If everybody is now if everyone is thinking what Bank of America is saying, but they didn't want to short too early, or they didn't want to exit their longs too early, or they had portfolio risk of not being involved in certain things on an end of the year rally or whatever, and that could be their motivation. If we're starting to actually break down here technically, I think that thought process is going to very, very quickly switch, where people are going to bail out on those short-term longs. We've probably already seen it here over the course of the last couple of days, and then potentially begin to reinvigorate their shorts as we go into the end of the year. So we'll see. Let's let the technicals, paint our picture. And again, at the end of the day here, the technicals are certainly not looking great. I would also note that a break of the uptrend does not a downtrend to make. A break of an uptrend is a break of an uptrend. A downtrend is a pattern of lower highs and lower lows. So just because, even if we did close below 393.50, which we technically didn't by just a little bit, but even if we did, we wouldn't be in a downtrend. We just wouldn't be in an uptrend anymore. So when you have that come into play, that's a more neutral market environment. It's more of a two-way, two-sided trading market environment. It doesn't automatically necessarily mean, from a technical basis, go 100% short. I really like to trade in the direction of time frame continuity when the market wants to give me time frame continuity. It just doesn't. Time frame continuity, I think, as we all know, is when I got an uptrend on the big picture, the intermediate picture, and the small picture. But this break of the uptrend here just makes me more bearish, less bullish, but not necessarily full on bear, because it changes our environment from long-term bearish, which we've already been, to kind of short, intermediate time frame neutral, if we really start getting that kind of close down there. And remember, we are still above that CPI, that last CPI low. And then we still do have next week, right? The 13th and the 14th, where we've got the 13th is going to be our CPI, and then the 14th is going to be our last Fed day of the year. And then who knows what the heck happens with that. But that ISM manufacturing number from yesterday was certainly not helpful. That's pretty much all I got from the big picture. As far as individual trades today, I'm definitely having kind of two rougher days for myself from a P&L perspective. With that said, today was a lot better for me than yesterday. Yesterday was a day where I lost money and felt that I traded extremely poorly. Today was a day that I lost money, but it's a day that I actually felt like I traded really well. It was mainly my swings that kind of were going against me that caused me to lose some money, which is natural in this type of environment. I like to risk money that I've already made in order to make more. So on big down days, if I got a long portfolio, I'm going to lose some money on that. But my day trading today and my small time frame trading, I thought was actually, pretty good and pretty on point. Albeit a little bit disappointed with some of the results of the move. They could have given me a lot more if I had a little bit of market help. But like my favorite idea for the day was sumo long through 8. Broke through that 8 off the open, gave a great 50-cent move on some momentum, like 14 cents risk there. It never actually broke that low to stop you out, but with the market failure, this thing kind of died on the vine a little bit, and then it ended up doing nothing, closing slightly above 8. It's tough because I really still like this sumo $8 play, but this tail here is atrocious. This is a really bad tail technically. The flip side of that is, what do you expect when the market sells as heavily as it did? If I would love to see where this sumo would actually be able to be if the market went up today. They really could have squeezed this thing to above $9, which is honestly what I was looking for today. But didn't happen. Was still honestly a pretty good trade. And then on the intraday, the intraday was really difficult here for the market. There were a couple of spots where I was looking for longs. One was right here at about 10.05, and one was here at about 10.40 off of those pivots. I do like measuring extension on small time frames and understanding the time of day and when you can kind of look for those counter trend trades. So it was really into this 10.05 extension. A couple names I started a little bit too early, but it was into this 10.05 extension that a price to time correction just seemed to be very high probability of a price or time correction. I was disappointed with the result, which was really almost entirely a time correction. The bounce on this was like almost nothing. Q bounce was maybe a little bit better. IWM bounce was maybe a little bit better, but this was primarily a time correction. But this degree of extension at this time of day, usually downside follow through without some sort of corrective price action becomes really difficult. And this type of candle here at 10.05, especially with the volume confirmation, can really be a signal to try to take trades on the other side. And again, all you can really look for in that type of situation is that counter trend bounce to equilibrium. And when it goes time wise, it doesn't necessarily always give you the opportunity to get some kicks. So I had a couple names where I wasn't able to sell anything, but a couple names where this was like miraculously the low of the day. Like Snap, I was one of the names that I kind of bought into this extension that turned out to be the low of the day. Shop, I remember calling out this higher volume hammer into this area as it approached this kind of like mid 38 zone, which is where I'm usually buying stock on this thing to begin with. That kind of turned out to be the low of the day. And there's another DKNG. I had called out that I was buying into this like 1410 area off of that. That turned out to be the low of the day. So I had like 4 names there that actually turned out to be the low of the day, which was probably a little bit lucky, to be honest with you, because I was buying based on the market giving a retracement, not based on low coming in for the day. And the market itself continued to just get destroyed. But I had like 4 stocks out of probably 7 or 8 that I was really buying there. That really turned out to be the low of the day. So I'm gonna chalk that up to luck as much as skill. Honestly, skill was being able to recognize this and putting those longs on. Luck was that those ones somehow miraculously seemed to hold the low of the day. So yeah, I had a few trades on the intraday that were actually pretty good for me and helped kind of save what could have been a bad day for me otherwise, as far as just giving back a lot of P&L. Like I got stopped at a woof today, which was one that I was in from this day. I never raised my stop on it off the daily chart, so I was giving it all the way back down to this low. My original price that day was like $10.20 something cents. Was able to book a lot on the way up. Never raised my stop on the core position. Added back a little bit of stock on the way down, so I did give back some of the profitability on it. But then got stopped out of that one on the daily. A couple others got really close, honestly, to stopping me out. but managed to not. And yeah, that's it. So I certainly wouldn't characterize today as a good day for me, but I traded much better than I did yesterday. And while I did finish down on the day personally, it could have been significantly worse. So what can I say? What can I say? Is what it is. You know, the flip side is that I've been riding a lot of these longs, like literally since this low. So, you know, if that's what you're doing, if you're trend following on these time frames, the thing about following trends is that you will inherently never get out at highs or at P&L highs. That's the nature of always being willing to risk money that you have made in order to be able to make more. So, and some of the positions I'm still in, so we'll see what they do. That's all I got. That's all I got. Happy to answer any questions that you guys may have. So let me scroll up here into the VTF. First I'm seeing here is from TJ on SWAV. So what's your question? Is this a good entry? August 9th gap fill alert went off today. I bought on the pullback. Inside bar at 330. It finished strong. Downside feels like April 12th, 223 pivot. First upside target 250th. 250-ish. Yeah, so I like the idea of paying attention to these types of gap fills. Gap fills can act as support. You still want to make sure that you get a signal beyond just the potential support for your entry, which it sounds like you had a little bit of an inside 5 and up. I don't really know this name super well. What time did you say that inside 5 was? 3:30. Okay, yeah, fine. I can live with that. And you got a little bit of a bounce here. And then your profit cushion is a little tight on keeping it overnight for me on the long side. And the daily candle certainly did not close well. This daily candle looks like it's going to want to break this low. So I personally would want to have a little bit of a better daily candle at the end of the day in order to keep it, and a little bit more of a profit cushion at the end of the day in order to keep it. But I kind of like your broad thought process on looking for support. You found a small time frame for the entry. I just this daily candle here is not good. Closing at lows usually means that this is not going to be the low of this move. But otherwise, I like your thought process on the spot where you're kind of looking for your trade to come in. Scrolling through here, looking for questions. What is the next economic number that could affect the current trend? Well, the big one is on the 13th next week when we get CPI, but we have PPI on Friday. CPI is more important. It's weird when PPI comes out before CPI. I think it's going to be the second time this year that has happened. So PPI on Friday will be market moving. CPI is probably bigger. Scrolling through here. From Ramon on Airbnb. Oof, wow, they wrecked this Airbnb. People are traveling though. Oh man. I remember seeing this here and actually saying that you could try long versus this low off of this extension. That certainly failed. All right, I thought about shorting Airbnb at 12.10. Okay, don't love the time of day here. 94.10. Against the pivot high of 94.75. Okay. Market was bear flagging, VIXI was bull flagging, the dollar was ripping. I ended up not taking the trade because I thought that 65 cents was too much risk. Your opinion on the thought process? Sure. I don't love the time of the day. I love everything else you're telling me. Stock is weak, market is weak, dollar is strong, all your confirming factors are there. Again, I don't love the time of the day. I don't love the technical setup on the entry that you were looking at either. To be honest, I would want to be like seeing a real pivot come in. I don't see anything at 10-10 specifically that's important to me. Like here, this pivot when it's on the way down, maybe you could short versus that high kind of deal. So that's what I would be looking to do in these weaker days. And you could have, by the way, I think I called out one short today. I think I called out this short here for the market. You can also be looking at with these downtrend days, and we've had this already earlier this year, like shorting versus these pivots on the way down if they give you the actual execution setup that you're looking for. Like I love that kind of continuation shooting star to the downside or the inside and down to form the pivot. You can that's what I want to be looking for on the short side for like a specific execution. I just don't really see that on Airbnb here. I love all your confirming factors. I just don't love the actual execution on the chart itself. I don't love the time of day, but I love your confirming factors. And if you decide not to take it because the risk was too much, that's always responsible. 10-year note is the worst year since 1788. Woo! Yep, classic fear trade's been a while. If they keep raising rates, won't treasuries keep getting hit? Or are they anticipating the recession or end of the rate hikes? Well, the treasury market has been leading the Fed the entire year. The treasury market has had the entire year. So, and I'm not a bond enough of a guy to be able to just tell it to you all off the top of my head, but like wherever the 10-year like should be, kind of based on where the Fed funds rate has been, or where the Fed was in the hiking cycle, it pretty consistently the 10-year has been ahead of it. It's been leading it. So what's happening now? Well, first of all, I had seen some arguments, especially at these lows, that I was paying close attention to, that the 10-year just got like, and I know TLT is like the 20-year, but that it just got way too far ahead of itself compared to where the Fed was in its actual heightening cycle. And again, this it's been leading the Fed the entire year. So it beginning to go up maybe, is a recognition from the bond market that they overpriced in what the Fed was actually doing as the Fed is kind of beginning to pause a little bit. So that would be one. But then two is, how is it possible that the TLT or that treasuries were able to lead the Fed is because the market is a forward-looking mechanism. And at a certain point, and I think I remember saying this also, when the TLT here was near its lows, it was like I would really begin to think that, if you can get 4 or 5% interest rates on, some of these bonds, that you would just buy that up. Like why would you take equity market risk when you can get, for like investors and portfolio managers, why would you take the same degree of equity market risk when you can guarantee yourself, 5% on some of these treasuries at a certain point? So I think that started to come into play a little bit as well. And I think that this last leg of it now has finally become a fear trade, which actually has an easing impulse where, they're starting to buy this up because they're like, I need safety, S&P 3000 is coming, the recession is coming, blah, blah, blah. So I think that's what's going on there, Mark. From Todd, do you think that the market is flattening out, neutral to prep for PPI, CPI, FOMC? Yeah, so that's one. I didn't actually say that in this afternoon meeting. That's one of the things that I was kind of leading towards as we've gotten into this neutral environment, that we might just want to be waiting for this next, event to occur, which is going to be Friday, Tuesday, and Wednesday. So we got a lot coming up. Maybe people don't want to be putting bets on in the same way a few days before that. I'm not really sure. Seeing choppy action while we wait for the numbers makes sense. This entire calendar year, outside of little bits and pieces during earnings season, this has really been a macro environment year. It's been all about the macro this year. So that's what the market cares more about. We'll briefly in earnings season get lost in, can Apple come and save the market on its earnings report kind of deal. but it's been a macro environment, and that's all that really matters is these next numbers, and then these next numbers, and then what does the Fed do next? So we'll see. From Toussaint, what sector rotations do you see this week? Industrials were pretty good the past few weeks. Has the trade dried up? Yeah, XLI here is pulled back. I still like some of these material names. Wow, look at this. Oh, this, forgot to mention this STLD. This was a money trade today that we discussed in the morning meeting, if anyone took it. The buy back through the inside day low when they initially hit these names down on the potential of these tariffs, these environment tariffs or whatever. And then look at this US Steel right back up, STLD right back. What did GDX do today? I still really like a lot of these material names. XLI looks okay. Pulled back a little bit. It was a little bit weaker. Utilities were strong. Staples have been strong as well, but had a little bit of a weaker day. So yeah, I mean, we'll just I can't tell you what's going to be relatively strong and relatively weak tomorrow because there's been so much flipping of relative strength and relative weakness recently, even on the intraday basis. And a lot of times I can get a pretty good feel on what I expect will be strong or weak, and just has been more difficult these last few weeks. So I don't know is the short answer. I'm curious to see the degree to which these fear trades continue. You know, is this TLT going to be at like 110 by the end of the week? Is XLU going to keep getting bid up, or are we going to get a pause on that at a certain degree? I don't know. From Trading Arsenal, what's up? Hit the like button. This channel is great. Appreciate it. Thanks for hitting the like button. Still trying to build out that YouTube, so if people don't mind, you know, giving me a view and a like on the YouTube afternoon meetings, I really appreciate it. From Mark D, out of curiosity, do you hedge your portfolio or do you use cash flow method to help hedge it? I don't really hedge. Is kind of the short answer. Into extremer parts of the market, I will take trades on the other side, which acts as a hedge, but I don't really view it as a hedge. I view it as a trade. The idea of like, you know, I'm long a bunch of stocks, so let me just like, you know, just start shorting the Qs or whatever with no stop loss has only ever cost me money over the course of my career. And I don't trade options. I'm really a directional trader who then trades on the smaller time frame for that cash flow. And that cash flow P&L can really give me a lot of cushion sometimes on a lot of these names over time, which is great. So no, I mean, into the bigger areas, into bigger degrees of extension, I will short. And I know somewhere in here, I think back in here after the CPI, I was shorting a little bit into this area, made a few dollars. Up here, I was shorting the Qs, made a few dollars. But those are trades that happen to act as a hedge. What else? Cup and handle on OLLI. Yeah, I can kind of see it if you mean like this. I'm not a big fan of the cup and handle pattern. I only like it on daily charts, which I'm assuming that's what you're looking at here. It is a continuation pattern. They're so built out so long, and they can be sloppy, and I feel like people overview them. So I don't know. I don't have a strong opinion for you on this OLLI chart, to be honest, and I don't want to mislead you. From Cyril, cool. I appreciate it. Airbnb downgraded to underweight by Morgan Stanley. Yep. Cool. All right. Looks like we got through the questions. Yeah, I appreciate the shout outs on the YouTube there. Smash that like button because that's what the cool kids, right, who have like big followings. Smash the like button. So have a great night, everybody. I will see you all tomorrow morning, and you know, we'll take it from there. We'll see what this market wants to give us with tomorrow's gap. Adios.